Hi all, welcome to FrankBanker podcast, a knowledge sharing platform for banking, finance and related technology. In this episode, we are discussing decentralized finance or DeFi. I wanted to break down this episode into two parts. One is that insights on decentralized finance. The second one is little more deeper on how it is going to impact banking. Okay, and first let us start with clarity on decentralized finance.
So to explain decentralized finance, Bala, I have to then first explain to you what is centralized finance.
Okay.
And then we'll have a good comparative there.
Okay.
So when you talk about centralized finance, we are primarily talking about presence of two important players. One player is intermediary, who acts as a custodian of all the financial assets, also as a channel for transfer of those assets. And second, you have a regulator who sets the rules of the game. Okay. So in decentralized finance, we are appending these two positions. So in centralized finance, we talk about where will the assets be kept, who will be the custodian of those assets, how the assets will be moved or transferred. DeFi is challenging that what, how, where. So that's in principle what this decentralized finance is. Now, in technical terms, decentralized finance or DeFi leverages blockchain.
Okay.
Because blockchain has the capability to, record in a way which is immutable, which cannot be changed. So you get a robust record there. And smart contracts, because smart contracts bring in the strength of, bundling the transaction, doing it in real time, capturing the information related to the arrangements or ownership of the assets. And mixing these two together, putting these two together, it is what builds the technological backbone for decentralized finance.
So Amit, last episode I think we discussed about blockchain, right? Okay, let us deep dive into the smart contracts.
So smart contracts is nothing but a piece of code which can store information, which can store what are the considerations of a transaction between various parties, two parties or more, right? And importantly, when certain conditions are met, it can auto-execute. So the automation part is what is essential or what is important contribution which comes from a smart contract. But automation is only one part of it, Bala. Smart contracts in the DeFi space are important because they have the ability to bring trustlessness to the transactions.
Oh, okay.
Now, by trustlessness, I mean that if the two parties are dealing and if there is a trust deficit, how do you ensure that evaluation of trust is not even required in the transaction? Now, again, if you talk about traditional financing, this trust deficit is, filled up by banks, by, other financial intermediaries. Smart contracts, give you a platform or give you the tool in which this is not required, because these transactions of two parties' obligations toward each other can be done simultaneously.
Okay.
Right? It can be done based on certain conditions automatically, and that is what smart contracts brings to the table, and therefore is a backbone for DeFi.
Okay.
Let me give some examples. Let's say if there are two parties who are doing a trade transaction with each other and there is a trust deficit, you will see intermediaries. A bank will come in and provide instruments like letter of credit or an escrow mechanism or a lien mechanism. Okay, because in smart contracts you can do it simultaneously, you can do that blocking simultaneously if it is digital currencies, right? You therefore don't need an intermediary. Another example would be, there are people who have money who are depositors, and there are people who need money who are borrowers. Now today, to link these borrowers to the depositors, you again need an intermediary, because borrower does not know the depositor, right? So somebody is pooling it up. Now what if you can pool it within a smart contract and execute it and give it to the borrower based on certain conditions or certain collaterals? Then again you are cutting out on the intermediary. So some of these points we will build up as we go along in the conversation. But smart contracts therefore provide that trustlessness aspect, automation aspect into the DeFi. And another very important aspect over there in smart contracts is their ability to bundle, which means that putting all the transaction into a single leg.
So Amit, can you elaborate on this bundling aspect?
See, bundling simply means that you have multiple transactions which are happening and they happen simultaneously and treated as a single pack or a single bundle. Okay, that is what it means. So, for example, if I am taking a loan against a collateral, now if there is a time lag, then there is a need of trust that who will give, who will do the transaction first, whether I will get the loan first or I'll give the collateral first. But if both things happen simultaneously, then you are again, making the need for this trust between the parties redundant. So that is what bundling does. It creates a single unit of multiple transactions. Now, because of this, if you are able to do multiple bundles or multiple sets like this or multiple packs like this, there is another feature which smart contracts provide, which is called composability.
Okay.
Composability primarily means that these sets, multiple sets which are there, or multiple transactions within each of them, right, can be put together, and then you can create more complex, contractual obligations which can be automated in the entire process.
What are the other DeFi use cases?
See, lending and borrowing is a primary use case there, and this happens in multiple ways. Right? So there are a lot of variations in which it can be done. A good simple example would be, let's say, MakerDAO, right, which is one platform where you can put your cryptos as collateral and take a loan in the form of a stable coin called DAI, D-A-I. Okay. Now, why would somebody do that? Because your crypto, possibly you would want to hold it for a period of time, you expect an appreciation, or possibly it is not a very liquid crypto, or possibly it has a lot of volatility in it, or possibly you have an opportunity of interest arbitrage. There could be multiple situations. But you can go there, put your crypto there, and in return what you get as a loan is DAI, or a stable coin. Now, stable coin is pegged to USD and therefore has a value which is relatively stable, not fluctuating. And importantly, DAI is primarily an Ethereum based coin, right? So it's an ERC20 coin token, and therefore is widely accepted within the DeFi space. A lot of dApps will be accepting DAI for various transactions, right? So that is one use case. Similarly, there is another concept within DeFi which is called staking. Now, in staking, it primarily means that you put in a money on a certain blockchain which you think is good or is stable or has good potential. And by putting money there, by putting your cryptos there, by money I mean the virtual currencies, okay, you also become a stakeholder within the governance structure of that particular blockchain. Okay, so that means you can be a validator on that blockchain. You can validate transactions. Okay, right, and what we call it as proof of stake.
Okay.
But without getting too technical about it, you are a part of the entire exercise or entire blockchain, and you are incentivized for it. Okay. For the work that you do as proof of stake, you are incentivized, right? Whatever money you are putting in, you are incentivized, right, from the fees which the platform would generate. Then another concept you have is the concept of decentralized exchanges, building up liquidity pools. So there they would incentivize people who put up their cryptos in that pool, right, who are called liquidity providers, and then that money would be utilized, or that crypto pool would be utilized for anybody who's wanting to take that money out. And again, there is an incentivization being given to the liquidity provider. So these are some of the lending borrowing cases in which money is to be brought in and given to somebody else. Now, apart from this, then you have something very interesting which is called flash loans, wherein you don't need to put a collateral. The loan and the repayment happens in real time, right? It's a strategy which can be adopted for, let's say, if you have arbitrage between two virtual currencies. Okay. Then there are other use cases. So, for example, you can put up your digital art and convert it into a bundle within a smart contract. Okay, and I'm using the term bundle a little loosely here, but you put the credentials of the digital art and create a token on that digital art, and then you can trade on that token. Now, this smart contract which is created carries these credentials, and once you transfer the token to somebody else, the ownership of the asset also gets transferred. The ownership of the digital art also gets transferred, and you can trade in it and you can buy and sell. Those transactions can happen. Another very interesting use case in DeFi is around DeFi insurance, which again, does away with the need for, insurance insurance companies, where again you are building on the concept of having a pool wherein people who have insurance claims based on certain conditions would be paid the reimbursement. Okay, and over here, of course, in insurance, the conditions, all the conditions based on which the insurance is to be paid out, may not happen on the blockchain, and therefore some events may happen outside the blockchain. So you have a structure of oracles who primarily take that information and put it on the blockchain. So there are multiple use cases of DeFi, and it is only evolving as we are going along. Newer and newer ways are coming in. Okay, so there is no limit to what can happen in future.
Okay. So Amit, how are the transactions happening? Are there any intermediaries in this?
See, DeFi in its pure form aims to have no intermediaries in between. So that would mean the platform that I'm talking about is a self-governing platform, governing by the stakeholders in the platform.
Okay.
Okay. So whoever the stakeholder, they become, and good part is anybody can be a stakeholder, right? As I've talked about staking earlier. So they are self-governing. Once a protocol has been set, that means the rules have been set. It will automatically, perform as per the rules which have been set. So your platforms like Uniswap, your platforms like PancakeSwap, they are decentralized exchanges, for example. Now, how does a decentralized exchange work? Again, by way of liquidity pool. So they create a pool of cryptos, and once the pool is available, then the buy and sell can happen on that platform, right? Because they are protocol driven, we call them as AMMs, or automated market makers, wherein the price of the cryptos varies automatically based on the demand and supply. So that's the decentralized exchanges, or the DEXs. They are intermediaries, but again, they are not intermediaries owned by anybody, right? Then you also have a concept of centralized exchanges, like your Binance or your Coinbase, right? They are decentralized exchanges who are owned by a specific corporate entity. They are like any other stock exchange or any other intermediary which might be there in the market, right? So both these type of intermediaries are there in the DeFi. In the pure form, of course, you don't want intermediation, but in the practical situation as we stand today, there are intermediaries governed, controlled by corporate bodies.
Okay.
But there is one important point here which I should add, which is that all these intermediaries are not without cost. All of them have their transaction fees. All of them have what is referred to as gas fees for providing those services.
Okay. Assume these are nominal fees?
This should be nominal. In fact, ideal world, there should not be any fees, any intermediation fees, but there are practical aspects to it. One practical aspect is, many of these apps or dApps are based on Ethereum. They work on Ethereum, and Ethereum has its own challenges of scalability and speed, right? So that means you need to incentivize for the computing power which is required to validate these transactions. Okay, so that is one need which is there. Also, the structures of giving returns to somebody on the investment that they have done, let's say on a liquidity pool, right, or let's say on the lending, right, also is arranged through these fees, the gas fees which are charged, and sometimes these gas fees can be pretty high. These are not necessarily nominal. Ideally, as the efficiency comes in, then this might become a little bit more reasonable.
Okay, sounds good. So Amit, why is Ethereum is preferred for DeFi?
See, I told you that in DeFi you require blockchain and you require smart contracts. So Ethereum was the first blockchain with ability to provide smart contracts, and therefore it has a first mover advantage. In fact, the total value logged in Ethereum is around 70% of the entire DeFi market, as per the data. Okay, but there are others. There are others like Solana is there, Phantom is there. So these Avalanche is there. So these have their own pros and cons. They solve some of the problems which Ethereum has. Okay. Then as new chains come in, then there is a question of interoperability between these chains. So you have bridges which link one chain to another in DeFi. Then there is Cosmos, which is a multi-chain platform. Ethereum is still very popular because, of course, as I said, first mover, but also possibly because of the trust factor it has.
Okay.
Others are relatively new. Also, from a security point of view, downtime point of view, Ethereum has proven to be much more robust.
Okay.
Therefore, Ethereum continues to be popular, and there are newer platforms coming every day. In fact, Ethereum 2.0 solves some of the problems of the Ethereum platform, right? And it is still an evolving field. So we do not know what will be the most prominent platform tomorrow.
Samit, you mentioned stable coins earlier. So what are those?
See, stable coins are a special use case of of cryptos. Okay, the only difference is that the value over here is pegged to a fiat currency. It can be a fiat currency. It can also be commodities, right? And therefore, there is a stability in the prices. And most of the time, the fiat currency is US dollars. So you have DAI, as I told you earlier, then USTD or Tether, and USDC. These are some of the stable coins. Now, from a DeFi point of view, this is very important because over here, what happens is it starts providing the stability in otherwise a very volatile crypto market. So once you have stable coin, it starts giving you the strength of a traditional financing system where there are checks and balances on the volatility of the currencies, for example, or the value of the currencies. So therefore, stable coins become an essential part of how DeFi is evolving because they provide that stability in the system. Then there are some there are some new experimentations there where there are algorithmic stablecoins, and of course, on the face of it, they tend to be a little bit more risky compared to stablecoins where they keep a pool of US dollars to back up the value of the stablecoins themselves.
So Amit, lots of insights on decentralized finance. Now let us move on to the next level of discussion. Will DeFi kill banks?
It's a tricky question, Bala.
Okay.
Will DeFi kill banks?
Okay.
See, there are various layers to this.
Okay.
Firstly, DeFi itself is a momentum of last decade or so.
Okay.
Right? So it has not gone through the cycles or the complexity which the traditional finance has gone through.
Okay.
So its ability to handle those complexities yet to be proven.
Okay.
Right? So that's issue number one. Issue number two is in DeFi there is a lot of technology going on.
Okay.
Right, and while technology solves a lot of issues, right, brings efficiency and so on, it also means that there is a learning curve for anybody wanting to enter the DeFi.
Okay.
So is it ready for mass adoption? Not necessarily. Does not mean the interfaces are complex, but it means your ability to have an intuition around the way you do transactions in DeFi is yet to evolve.
Okay.
And people would have to go through a learning curve to adopt it.
Okay.
So there are challenges in DeFi. So will it kill the banks? I'm not sure, but it will definitely change the way banking is done.
Okay.
What
so
we
there is
mean
a
by
challenge.
There is a challenge for banks, and they
Okay.
possibly would have to pick up pieces in what DeFi brings to the table, but it will impact the way banking is done because it brings in efficiency. For example, the whole question of an intermediary being a custodian of your financial assets.
Okay.
Right? So that means when I put money, it is put in bank, and bank has that money, right? Instead of that, can I keep my money with myself and move it without relying on an intermediary? So that is what DeFi brings in.
Okay.
So the ownership and what is the value of it today, what do I want to do it today is entirely in my control, right? Without a dependence on the intermediary. So DeFi brings a lot of things to the table. It has its own challenges. So it's a long haul, I would say, before DeFi becomes very, very commonplace. And if to answer your direct question, whether will it kill banks, I would say that there is a big wall in front of DeFi, which needs to have some holes, and that wall is the regulatory wall.
Okay.
Right? Unless and until that wall has some holes, DeFi cannot pass.
That's going to be my
mainstream.
next question, actually.
Yeah.
Okay. So Amit, do you think that will regulators permit DeFi to go freely?
So see, we can only gauge by the response we have seen. So RBI brought in a circular in 2018, right, where it barred the regulated entities, banks, etc., to provide any support to virtual currencies. So it has literally killed the the domestic exchanges which were there. Okay, and more recently they have put up, they have barred a few exchanges again, Binance included, which do not have an operations in India, or which do not have a entity in India. Sorry.
Okay.
So regulatory view is very, very clear. I think the bigger threat to the regulator comes in from the impact that cryptos in particular would have on the monetary structures. Okay, because while we can talk about what are the strengths of crypto and and what it brings to the table and what technology can do for us, it does not give us a proven way of a monetary structure which can help manage the economy properly, right? So unless and until that happens, I don't think a regulator can behave like a cowboy and permit laissez-faire or free for all kind of a thing. So there is a merit in a regulator being prudent, and as I've already told you that there are challenges in terms of its ability to be adopted. And also as I said, right, even today with so much of history of traditional finance, you see frauds and you see people who are gullible to these frauds, right? In DeFi the chances are all the more. FTX is one example, right? Wherein the system was gamed in a sense. So there are merits in what regulators are thinking. I don't think they are going to push this out in a hurry, right? Push the doors open in a hurry. But one thing I would say, Bala, right, that the intermediation piece, right, is something that has to be relooked at.
Okay.
And the value that the intermediaries bring to the table has to be relooked at it. I'm not talking about the dilute away and wash away the concerns on the systemic stability, but the intermediation game which is being played by banks and other financial institutions needs to be relooked at. It needs to be made more efficient.
Okay. So Amit, is there a midway?
Midway, you mean between the regulators and the DeFi, right? Yeah. So I would say possibly CBDCs plus the DeFi can be one direction.
Okay.
Now, moment you bring in CBDCs, regulators comes into the picture, and therefore you are not doing away with the centralization part of the DeFi. So it's not pure from DeFi, but I think that could be one way, because in DeFi, as I talked to you about, stablecoins, right, become a big backbone, and CBDC can become that.
Okay.
And it also gives some control to the regulators, right, to ensure that whatever their monetary policy structure is maintained. So if you mix the strengths of DeFi along with CBDCs, so what you are talking about is two entities in the market, right? One is DeFi protocols, which is again not owned by anybody particularly, no corporate engagement there, and the regulator. These two put together does one thing. It says there is no need of banks.
Okay.
But this has to happen. So we are talking about possibly a little bit wishfully, right? But if this can happen, a regulator along with the DeFi protocols, right, can create a system wherein the systems are more efficient.
Okay.
You do not have the inefficiencies of the banks. So banks are a good tool, but they have their own inefficiencies, which DeFi possibly can address. But it's a long haul, Bala. I don't think it can happen very, very fast, because the time period which is there is pretty small.
Okay.
As I said, only a decade or so. But things are moving at a very fast pace. So I'm hopeful. I'm watching this space with a lot of excitement.
Oh, okay. Very nice. Okay. Very nice. Very nice. So Amit, thanks for the insights. I'm sure audience would have enjoyed all the insights. And at FrankBanker, always we simplify the subject, even it's a complex.
We try that, Bala. That's our effort.
So viewers, I'm sure you would have got a wonderful insights on decentralized finance. Do like, comment and share. Thank you all.